The hidden financial blueprint behind America's greatest economic crisis. 1. The secret origins of America's central banking system. In the early 1900s, a small group of powerful financial leaders created a plan to reshape America's money system. They met in secret and drafted the structure that later became the Federal Reserve. So what does that actually mean? It means the United States banking system was built using a model that placed major financial control in the hands of a few institutions while appearing to protect the public. Footnote: this section explains how early banking leaders designed a system that centralized monetary power. 2. How centralized control shaped the economic collapse. When the Great Depression hit, thousands of smaller banks failed, but the largest institutions expanded by buying distressed assets at extremely low prices. Their control over credit and monetary policy made the crisis worse for ordinary people while creating opportunities for those with liquidity. So what does that actually mean? It means the system helps some banks grow stronger during disaster, while smaller institutions and homeowners suffered. Footnote: this section shows how economic crises strengthened large institutions instead of weakening them. 3. The rise of global financial coordination. After the crisis, international banking groups created systems that connected central banks across nations. These structures allowed financial powers to coordinate policies globally and influence economies beyond their borders. So what does that actually mean? It means monetary decisions moved from national control to international cooperation, giving global institutions more influence over local economies. Footnote: this section highlights how global banking networks extended financial influence worldwide. 4. Why regulatory reforms failed to fix the root problem. Although government reforms appeared to restrict banking power, the core structure of the financial system remained untouched. Large institutions kept expanding because regulations weakened smaller competitors and protected the biggest banks. So what does that actually mean? It means reforms looked like solutions, but mostly strengthened the same financial groups who shaped the system. Footnote: this section explains how reforms maintained concentration of financial power. 5. The repeating pattern of crisis and consolidation. Throughout American history, financial crises follow a predictable pattern. Loose monetary policy creates bubbles, bubbles burst, and the largest institutions buy distressed assets for pennies on the dollar. So what does that actually mean? It means crises are not random. They consistently shift wealth upward to those positioned to take advantage of collapse. Footnote: this section shows how repeated economic crises enable ongoing wealth consolidation.